and welcome back to the ROI channel, the channel that's obsessed with all things to do with the art and science of return on investment. And today we've got another stock review. We're getting through them. Currently got 33 positions in the Crassus portfolio. Today we're talking about Exxon Mobil, okay? One of the biggest oil producers on the planet, and oil's in a very interesting space right now. It's getting a lot of negative media, a lot of negative narratives, and that's fantastic because whenever there's a narrative that's not supported by reality always wins, although not immediately. And therefore, for us as investors, we're looking to take advantage of any delta or gap between value and narrative if we can work it into our favor. So without further ado, let's get into it. If you haven't already subscribed to the YouTube channel, please do so. I greatly appreciate that. Thank you to all the guys that have been commenting and the guys that told me that the link wasn't working to my eToro, so I've fixed that. Hopefully other people tell me that it's working, and yeah, I appreciate all the comments and subscriptions. That's what will give me the motivation to share them to YouTube. Otherwise, I'll just simply upload them to eToro or keep it to a private group. The Crassus investment formula, what we look for when investing in public or private businesses for that matter: low debt. We want a margin of safety in terms of the price to value or the secular outlook for the industry and the metrics which we use to value the business. We're looking for sales growth, obviously, strong margins, free cash flow growth in particular, my personal favorite, and ideally a company with a history of share buybacks. Okay, so let's have a look at how ExxonMobil stacks up to that investment formula. So revenue top line expected to come in at 277, we'll call it billion US dollars after what was a horrendous year for the oil industry last year with COVID. The demand side just went through the floor. And you had a negative oil futures, meaning the contracts were negative. You had to pay someone to take the contract off your hands. A very bizarre set of circumstances, but great opportunity. Made quite a bit of money on oil futures and swaps that were exchange traded. Anyway, that's another story. The Ebitda is coming in at 48.3 billion, and the company's been able to grow that at 8% compound annual growth rate over the last 10 years. That has been smoothed out over a 10-year cycle because obviously last year was an adverse impact due to a very bizarre year. Market cap $228.5 billion, enterprise value $292.7, $53.98 is the share price as of the recording date. $4.2 billion in 0.2 billion shares on issue, and the company bought about 10 million shares back last year, which is about a 1/4% reduction, and we're able to solidify, reducing their capex, solidify their balance sheet, meaning that they have sacrificed a little bit of future growth potentially to be able to provide value to shareholders to ensure the company's survival in a pretty dismal environment that was last year for the oil producers. So I'll give them credit for that. They've maintained their dividend yield at least 6%. So we're getting paid to wait on this stock, and I'll explain what that means in a moment. Return on capital, excluding 2020, 5%. Very capital intensive business, the oil business, and net debt to Ebitda at 2 times there. So that's within our reasonable margins. So let's have a look. ExxonMobil produces 2,349 barrels of oil a day, and the average production costs in their various rigs or the various drills are as follows. You can read that there. They do vary differently from Europe, Asia, and Africa. That is just the price to get the stuff out of the ground. Okay, so that's not to cover costs. Analysts estimate between 45 and 50 US dollars per barrel gets the stuff out of the ground and covers the costs of the SG&A, the management costs, and so on and so forth, including the dividend. Okay, so that's the number we need to keep our eye on as investors. If oil starts dropping below $45, this company is starting to bleed cash. And what's interesting is that it's a marginal producer, meaning that there are other companies around the world that can produce oil at much lower costs. Saudi Aramco and some of the Russian companies can produce oil at a much less lower cost. But when you're in a bullish environment, if you're buying a marginal cost producer, when the oil price starts to lift, they have a disproportionate bullish effect or disproportionate gain in their cash flows. Okay, it takes a bit to get your head around, but if you've got a cheap producer, they can keep making money at lower prices. So that's their advantage. But obviously, as that starts to increase, their commodity price increase as a percentage, yes, obviously increased cash falls to their bottom line, but the rate of change is slower because they were already making a higher percentage of free cash flow. Okay, whereas if you have a high cost producer, in the bad times, that's when you can start to run into trouble because it's a very slippery slope, a very quick drop below that cost of production before the company starts to lose money. But on the opposite side, if you believe that there's a secular bull market, the rate of change in terms of the profit dropping to their bottom line is disproportionately large as that commodity price, in this case oil, starts to go above the all-included costs. So the all-in sustaining cost and the cost of capital and the cost of dividend in Exxon's case. So reduced capex, it lost quite a few of its rigs last year. So what they said was, okay, a very capital-intensive business, all these drills and rigs and so forth cost a heap of money purely to maintain. So we are going to cut that back so we can get through the lean times. So that may be a bit of an issue moving forward in terms of they'll have to then spend more money on capex in the future to be able to ramp up their production. But in terms of their cash flow and survival and being able to give back to shareholders and create value, that's a positive. There's more free cash liberated on the balance sheet, and they now have optionality on that cash, which moving into the future, if they decide that they're going to do mergers or if they're going to buy out other rigs or so forth, they may use some of the rigs from another company in our portfolio, Transocean, and they have that ability. So analysts are unhappy at the moment because they're missing on production and what they expected, but they're actually beating on earnings and free cash flow. So for a marginal producer amongst the majors, who's going to have the most disproportionate benefit on the upside if oil is to shoot into a bull market, which I believe that it is? I believe that oil will be looking at maybe triple digits by the end of 2021. We'll see. But Exxon is going to start to outperform your Chevrons and your Royal Dutch Shells in that scenario. Okay. Price action over the last year, there we are. Okay, so as you can see, got up to a high of around about $64, and now it's dropped back to almost the median price point. If I overlay Exxon's performance against crude oil, that is the raw commodity that they sell, what's very interesting, if you follow the cursor here, normally this is what we'd expect to see. You'd expect the producer to have leverage on the underlying commodities price. So here we would see, okay, oil's at a certain price, Exxon Mobil will trade at that plus a bit more because it's a producer and can value add in terms of the commodity. And then it starts to reverse. So we had a crash last year down here due to COVID. Stock price recovers in lockstep with oil as we expect, but here the trend reverses. So oil is actually outperforming ExxonMobil. So a barrel of oil it costs more than a share in ExxonMobil at the moment, and I would expect that to mean revert into the future, like where we were in the good old days as far as the oil conglomerates are concerned, around about here. Okay, so it'll be interesting to see what happens. In any case, the bottom line is that the performance of Exxon is tied to the performance of oil. Okay, all right. Short-term views. End of 2022, the free cash flow, the Ebitda on a per-share basis, and the earnings per share are expected to come in as listed there. And if you apply the median multiple for each of the following metrics, this is what the implied price would be for each of those. So if you add those up, evenly weight them, as an average, we're expecting the Exxon's price, go back there, to fall in around $66.80 a share. So over a year, that overlaid with where the price is now, that's expecting or indicating a 24% upside, which is really good, above our 20% IRR. If we could get that, and then we decide we've got other opportunities, nothing to stop us taking profits and rolling that into another opportunity. Let's look a little bit longer term if we can. Our Ebitda on a per share basis is listed here. And so what we're saying is if we buy the shares today at the current price, and this is the base case. So with my base cases, what I generally do is take historic trends from the last 10 years, if I think that's appropriate for the particular business, and project them into the future in terms of the growth rate. So this is where we're expected to come in, and this is the growth rate that we would expect smoothed out over a 10-year cycle, and an industry median multiple. So meaning at the end of that time, we're collecting these cash flows, and we're going to sell the cash flows at a multiple, okay? And that's what the stock price represents. It's representing the underlying earnings or cash flow, and it times by a multiple. And that will depend on the popularity of the stock. That will depend on what investors are willing to pay. So I've been fairly conservative with that. We may be in a bull market at the end of year 10. There may be so many problems with this green energy idea that lots of people have around the world, that oil supply has dropped off and there's been no incentive whatsoever to continue supply onto the market. Oil price may be through the roof, and so your multiple might be double that. We don't know. So we're being conservative as our base case. These cash flows or earnings have been discounted back at the company's weighted average cost of capital, and that's giving us an IRR of over 20%, okay, which is really, really good. You're doubling your money every sort of 3.5 years. Doing the same thing, but taking the free cash flow and running it through the same base case for its appropriate model, discounting it back at the cost of capital, and we come up with 21%, okay, as an IRR, which is very, very good, particularly given it's one of the biggest companies in the world. Going through our base case, bear case, and bull case, what I've done here is stretch it out over a longer 10-year cycle and use the inputs for the Ebitda, the free cash flow, and the earnings growth, as I so often do, and applied probability weightings to each of the scenarios. So as you can see here, it's a fairly even spread in terms of the probability. I don't think that's appropriate. It's appropriate in terms of discounting the uncertainty. I don't think it's not what I really think is going to happen in terms of the probability of having a bear case at 30%, where the company only grows its Ebitda at low single digits, and have a terminal multiple at 3 times enterprise Ebitda value. I don't think that's going to happen. I don't think we're going to be living in a world where you can buy Exxon Mobil for 3 times its earnings before interest, tax, depreciation, amortization. But however, being ultra conservative and using our discount rate of 20%, we are getting an average summation for the Ebitda for an intrinsic value of $88.84, meaning if we want to get 20% our money, holding it over 10 years, assuming this is true and correct, or that it plays out that way, we would need to buy the shares at that price or below. And if I do the same thing but using free cash flow and earnings per share, I average them up, equally weighting them all, and we get an intrinsic value of $77.54, okay, at our extra margin of safety, if you want to call it that. Where I really start to load up the truck is if we can buy those shares at 2/3 the average intrinsic value, and that would be at around $51. So we're trading at just shy of $54, I think. And so we're not too far away from that. So we've got a position in Exxon Mobil, and we're looking to hold it, hoping that we can slowly add to it in the future. So that's the vertical holding at the moment. I entered in at around, I think, $52 for the fund, and we've got about 2% of the assets under management. It's definitely a company that is underappreciated at the moment, I would say, and so that always leaves us with opportunity. The company does have low enough debt at 2 times net debt to Ebitda. It's got margin of safety in the sense that I believe it's in a secular bull market. I believe oil is more likely to go up in price than it is down. And it can definitely make money with oil at about $66 a barrel. And anything on top of that, because of its high cost productive nature, is going to disproportionately impact Exxon Mobil as opposed to your Chevrons and your Saudi producers and Royal Dutch Shell, etc. So we've got margin of safety in terms of how we've measured the expected cash flows and earnings. It has got sales growth. It's got margins that are good enough. It's got free cash flow growth, and it could potentially buy back its own shares. I don't think it will. I think it will invest more in capex and production, but it does have that opportunity moving into the future. So there it is. If you haven't already liked and subscribed, would greatly appreciate you doing so. If there's a stock you want me to cover or any questions or comments, put them down below. And if you haven't checked out the eToro platform, that link is wrong. I'm going to put the correct link in the description. And if you have any issues, leave a comment. Add us to your watch list, and you can keep an eye on the Crassus investment portfolio. Or if you've got funds ready to invest and you want to rock and roll, just hit the copy button, and it's very, very easy to do. And disclaimer, as always, I'm not your financial advisor, and you should take everything you hear with a grain of salt on the internet. In other words, you're responsible for your own decisions. So be responsible, do your own due diligence, and I wish you the best of luck with your investing. We'll catch up in another video soon. Cheers.